guys, how's it going? This is another subscriber request. This one is QSR, otherwise known as restaurant brands. So first things first, let's actually take a look at the website so you guys can kind of get a feel for what are their brands, right? So you may be familiar with some of these, right? So you have Burger King, Tim Hortons, Popeyes, Firehouse Subs, right? So you guys can think to yourselves whether or not you like any of these brands. For me, I think the only one I like is Firehouse Subs. I've never been to a Tim Hortons, so I can't say anything about that. Popeyes is meh. I prefer my Chick-fil-A, and can't say anything about Burger King. Right. So that's all that. Let's go ahead and look at the price action, see what's going on, or the longevity of the stock's been quite, let's see. Yeah, not good. 52% all time. So I want to actually show you guys something. This is kind of my rule of thumb. It doesn't have to be your rule of thumb. And I mentioned this before in previous videos, but let's take a look at this. So we have restaurant. Yeah, it's Restaurant Brands International and 3G Capital. Okay, so this is kind of a rule of thumb for me. Okay, this doesn't have to be your rule of thumb. This is my rule of thumb. Okay, I don't touch anything that this company touches. Okay, now if you work for this company, I'm very sorry if that offends you. However, I will not invest in any business that 3G Capital touches. Right. I kind of look at their track record, and I kind of think that they're very short-term minded management team. They invest into businesses. They make them invest in all the wrong things. They don't let them focus on the longevity of the business. They try to cut costs everywhere. So anything and everything that this business touches, I'm out. Right. There's a lot of things that they touch, unfortunately. And Kraft Heinz is one of them, for example. Right. But this is another one. So I already, because of that, I can't invest in this. I follow my rule very strictly. If 3G Capital touches this business, I'm out. If I'm in an investment and then they buy up a ton of the shares, I'm out. I sell it that day. Right. Some people might view that as a positive because all this volume's coming in. The price may be going up. I don't care. I'm out. Okay. So I don't touch anything that they touch, but let's take a look at the business separately and take my bias out of this. Right. But I'm letting you guys know my bias immediately before we begin. 3G Capital touches it, I'm done. Okay. But yeah, for the most part, we see the same kind of thing. So from May, yeah, all the way. Wow. May in 2021, they've just been coming down. Stick. Okay. Yeah. It's down 21%. So hasn't been too good of an investment over the past year. However, does that mean going forward, is it going to be a good investment? I don't know. I'll tell you this, McDonald's, way higher quality company, but okay, I'm kind of, picking the Goliath with David here, and I'm saying Goliath is better. Whoop-de-doo, right? But I'll tell you, I even prefer Wendy's, right? So WBN stock, Wendy's, I think is a better business. I think they're not at a good value. That's separate. Remember, stock from the business, right? But I do prefer them as a business rather than QSR, and they're more focused, right? QSR has all this other stuff going on, and to be frank, I think from the Burger Kings I've seen, they've kind of let themselves go, pun intended. So let's take a look at the model and see what the model really tells me. So let's actually plug in QSR. Okay, so let's remove these growth rates because we don't know. Okay, so buybacks, they've been dilutive as heck. Let's assume 2% dilution. So they're not going to dilute us as much. We already cannot assume 0% growth. Let's assume 15% required rate of return. Let's go right into it. And then dilution accretion. So what this is telling me, immediately when you see dilution, I go to this tool that I created. It's called dilution accretion. Basically what it tells me is if they are diluting, by the way, if they're not diluting, you would ignore this, right? When the final model is out and ready for everyone to use, you would ignore that. And you would say that number is telling you basically, based on their dilution, are you actually gaining on a per share basis? And the answer is yes. All right. So the dilution is not that bad, right? So we're actually gaining. So they're using the capital efficiently. So that's a good thing. Okay. Because remember, separate the fact that 3G Capital is invested in it. Let's talk about just the business by itself. That's a good thing. All right. And taking a look at what the analysts say, this company is a buy, 29.5% upside. And yeah, that's what they say, right? So let's take a look at the key ratios, and then we'll come up with some growth rate estimations. So taking a look at the current ratio, looks really good. Cash ratio, fantastic. Total debt ratio, okay, that's fine. Long-term debt ratio, it's getting better, right? Or actually, no, it's the same. My apologies for that. Then long-term debt to capital, the same. Gross profit margins, about the same, better actually over the longer term. Operating margins getting about the same actually. And we saw pandemic lows, right? But that's fine. They're back to normal. Net profit margins are, about the same. So stagnation basically is the theme of this business. And taking a look at the earnings quality are really good. Okay, so management gets a good score there. Anything above 1 is great. And book value per share, don't really care too much about that. They don't really own the real estate, so book value is not really going to be a big thing. McDonald's owns a lot of the real estate. QSR owns maybe some, but not really all of it. I know a lot of REITs that rent out to this business. All right, so let's take a look at that inventory management. All right, fantastic. So basically, they're good on collecting the cash. So the cash conversion cycle is mainly what my eyes go to. So that's indicative of the power of negotiation that the business has with their customers, with their suppliers. So they're getting cash, right? Negative is really good. Cash today is worth more than cash tomorrow. So you want to think about that. All right. So going back to the summer report, let's take a look at what we think could grow. So let's assume that they grow on average 6%, and then on high end 10%. And then on the low end 2%. All right. So basically we're absolutely dead in the water here because we can't buy this thing. We'd have to wait, right? Immediately, right there. 15% is my minimum required rate of return for a business of this type. And then the growing complexities with regards to competition adds some more uncertainties that I would require a higher margin of safety, not a lower margin of safety. And let's see if they start to dilute us into the same extent, right? That's fine. So, and another thing, let's actually take a look at this. So restaurant brands, international, I don't care about 3G Capital. Is a very easy thing to look up. And then we do acquisitions. Let's see when they acquired Popeyes actually. So they acquired it in 2017. Okay, so that's my answer for that. Now I know why this is happening. So this dilution is also counting in those shares that were probably done there. So let's actually lower that. And let's say that's a negative 1%, right? So I don't think they'll do 6%. I think that's because of that acquisition that occurred. And that's my hunch, right? Immediately when I see large dilution for something that's supposed to be like a cash cow, I think they acquired something. All right. But basically with that dilution, I really do have to assume 10% growth or more in this business. Will they achieve it? That's a question you got to ask yourself if you're wanting to invest in this. Is this normal, right? But the trend line's kind of there because it's up and down. It's very cyclical. The sales, however, they're up and to the right with this cyclicality in 2020, this trough down here, and they got to recover. Okay, so and it tells me right here, the models tell me they haven't recovered yet technically for their all-time highs in terms of performance. So, ooh, that's interesting. Altman Z-score of 1.27. That indicates that there's risk on the balance sheet. And I think what is that coming from? Let's go back to the key ratios and investigate that together. So total debt ratio is pretty high. Okay, maybe it's this long-term debt ratio and the total debt ratio together. Let me backtrack that. Interesting. Okay, long-term debt to capital. Yeah, that's decently high. So they are a higher risk than what I would like. So further increasing that margin of safety, I got to go back here. And some of you may think that's too much, but I gotta ask for a 20%. All right, so I need this to come down substantially. I would need it to be, if I was even interested, by the way, I'm not interested because of 3G Capital, but if 3G Capital was not involved, then yeah, I'd be interested probably, if I'm being honest, at 28 and below, right? Because I think I can comfortably assume 6%. And then if I get below that, even better. And let's take a look at if my wishes will ever come true. So taking a look at the 5-year, okay, it happened very briefly, but it did happen, okay? So we got down to 32. It's probably unrealistic that it goes down to 28, but yeah, I'm being a little bit strict. I'll be honest with you. I'm being a little bit strict with QSR, but I think it's warranted because there is some, balance sheet risk. And I just don't. Oh yeah, what am I saying? Yeah, there's some balance sheet risk. Look at that enterprise value, guys. All right. Sometimes my eyes miss things, but it's all right there in front of me. So that market cap to enterprise value, that kind of tells me there's a lot of value on there that is a debt. Okay. So that enterprise value is 27 billion, but the market cap's only 17 billion. That's coming from somewhere. That's the long-term debt. So that's money they owe other people. That's the third party you're dealing with. Okay. So maybe I'd be interested in looking at the play on the bonds, but as far as the common stock, a little too risky for me. All right. I don't know about you guys, but for me, this is kind of like meh, but not a terrible business. Okay. The one thing that puts me off immediately from the beginning is the 3G Capital thing. Do not, don't take that as like a rule of thumb. That's the fact. It's just my personal opinion. Okay. On that note, guys, I hope you guys have a good one. You guys like this video, think it provides value, go ahead and smash that like button. Feel free to subscribe if you want more content like this, you want to see it more often. If you guys have any other requests, go ahead and leave them down below. I'm trying to get through more of these more often. And again, I'm doing sector analysis now. The first sector analysis video should have come out by now, so you guys should have seen that. Also, there's a video that is on my channel. I'll actually show it to you guys right now. Don't forget to see this one because it just got released because it was on copyright. It's this one right here. Will the market bottom soon? So right here, this video, go check it out. It actually was blocked by YouTube and now it just got released, and you can just watch it for this small entertainment here at the beginning of the video. And I hope you guys just find that entertaining. A lot of that information, unfortunately, now is I also wanted to say, you guys should go check out this video right here. It just actually got released by YouTube. Unfortunately, a lot of the information is out of date, but the point of the video at the very beginning is some entertainment value. Or you can go check out the video on the Instagram at Capital Mindset, right? If you check out our Instagram page, I think there should be a link in the description of this video. There isn't, but here's the name anyway. So you go follow us on Instagram and you can see that video. It's basically where I'm going to be posting finance memes. And if you guys are interested in seeing some finance memes, getting a good laugh out of the day, I make them custom, I edit the videos and stuff. And I know that from now on, they're going to be up there first. I'll try to get them on YouTube as well, but YouTube's going to, copyright strike me every time, So on that note, guys, I hope you guys have a good one. I enjoy making this content for you, and I'll see you guys on the next one. Bye.